The accumulation of over $700 billion of debts over the past 20 years has created an uneasy environment for many analysts. The International Monetary Fund says that 22 low-income African countries are in or at risk of debt distress. Many of the loans are due to be serviced in the next 2 years, creating some fear of further market turmoil. The specifics of African sovereign debt are incredibly nuanced and also require a deep dive into country-specific situations as well as multilateral relationships. And while we've heard the doom and gloom stories around Africa's sovereign debt, there are those who believe that by 2024 into 2025, many of Africa's debt-distressed sovereigns will have successfully restructured their most unaffordable loans, whether domestic or external obligations, placing these countries in a much better stead to attract private investment, in particular from sustainability-focused and impact investors to address a $100 billion annual infrastructure financing gap. Joining me now from Johannesburg, South Africa is Dr. Robert Besling. He's the founder and CEO of Pangea Risk, which is a specialist intelligence advisory company that focuses on political security and economic risk in Africa and the Middle East. Dr. Besling, thank you so much for joining me on Business Edge. Welcome to the show.
Thank you for inviting me. Lovely to be here.
I want to start with this in terms of the high level of debts that we've seen African economies basically gather together in the past several years. And we know that international trade operates on financing on loan and debt. It's nothing new in particular, but these sustained high levels for African economies have been ringing red flags and alarm bells for a number of years now. So let's start from there. What is holding this high level of debts for these prolonged periods? What does it mean for African economies here on the continent?
I think we're not really talking about short-term trade credit. That is not the problem here. Those are usually cleared in a few months, and that is an aspect completely on its own. What we've seen over the past few years is an accumulation of long-term debt. You mentioned the number 700 billion earlier. That seems to be where over the 20 years before the pandemic, where Africa has ended up in terms of its cumulative borrowing from other countries and from external and domestic sources. So obviously that is a huge amount, and that usually has maturities of several years or several decades to repay. The problem is that economies have not been able to generate sufficient amount of revenue, whether that be local currency revenue or foreign exchange revenue, to actually service, let alone repay that debt. So now we see African countries going back to debt markets to try and roll over or reprofile these existing debts. So essentially, it's becoming a vicious cycle or an endless spiral. And that is where, at the moment, a number of African countries, we've seen the IMF explaining that they are in a state of distress or at high risk of being in a state of debt distress. Or we've actually seen a number of default scenarios across the continent as well. But I think it's very important to note that there are 54 African countries, and not all of them are in debt distress.
All right, so going from that, let's do the math with the IMF. So the IMF is putting the number at 22 low-income African countries that are in or at risk of debt distress. And we see that from 2024 onwards, there are some really big Eurobond capital repayments that need to be made. And there are a number of high-interest countries that many of us will be focusing on. But let's look at the payments first of all. How dire is the outlook when it comes to repayments for African countries that need to be made in 2024 into 2025? What are we looking at?
So into 2024, we're particularly worried about a number of euro bonds. These are the hard currency denominated international bonds and which are commercial of nature. So this is not bilateral debt, this is not concessional debt, this is not another form of commercial or syndicated banking debt. This is specifically referring to those Eurobonds. And over the past 10, 15 years, we've seen lots of African countries, from Kenya to Nigeria, tapping in to these international bonds. And that has certainly been very beneficial for this long-term financing of infrastructure. But now, with the multiple hits to African economies, such as the war in Ukraine and the pandemic, we've seen a number of sovereigns unable to service or repay these. And the big maturities are, in fact, starting from 2024 onwards. And there's a couple of countries to mention. First of all, I think very much at the forefront here is Ghana. Ghana needs to make about $4 billion worth of repayments over the next 3.5 years on these Eurobonds. Now, we all know that Ghana has already defaulted on its servicing of one Eurobond. So based on the current scenario, it does not seem feasible that Ghana will be able to actually repay those maturities. But then if you actually look at other African countries, like Kenya, for example, or even Ethiopia, these have much smaller maturities due. Kenya has one due of about $2 billion in 2024, and then another 900,000 million over the next few years. Ethiopia has a $1 billion maturity over the next few years. But there we're talking about potentially reprofiling these international bonds rather than completely restructuring them. And what I mean by that is essentially pushing out the maturities, even if there needs to be a higher interest rate on them, to avoid this accumulation of big maturities in the short term. So it really is Ghana that we're particularly worried about at the moment in terms of its Eurobond maturities. But other major Eurobond holders and countries on the continent which actually have big maturities due in the next, say, 4 years, like South Africa, like Kenya, like Ethiopia, we're not particularly worried about them because they still have a lot of options left on the table, including issuing new Eurobonds or actually repaying them on schedule, particularly as we're seeing countries like Ethiopia seeing an uptick in their economic outlook and an increase in their foreign exchange reserves. There's actually a scenario where some of these Eurobonds can actually be completely repaid on time. So again, there's a couple of countries out there where the alarm bells are ringing, should be ringing, but not the whole of the African continent is affected.
And I think that's good news, but you didn't mention one that I'll have to be very specific about, and that is, of course, Nigeria, the African continent's largest economy, most populous black nation. There have been a lot of issues in the past 1 or 2 years, and we're on the cusp of a new administration. What does the outlook look like for Nigeria when it comes to this debt restructuring, Euro bonds, even reservicing, as everything might be for the country?
You know, Nigeria is a completely separate conversation, isn't it? It's particularly because of the very big political and economic changes we're seeing. In terms of Eurobonds, Nigeria has capital maturities due of just under $2 billion over the next 2 years. Given the size of Nigeria's economy and given the extent in which it can tap into foreign exchange reserves, there's no real concern that Nigeria will actually default on those capital maturities. The bigger concern at the moment in Nigeria is domestic debt. And that's really coming down to the central bank and federal government habit over the outgoing administration of an overdraft account, where essentially the Central Bank of Nigeria has been lending directly to the federal government to cover budget expenses, to cover the fuel subsidy, to cover repaying of other debts. And now the outgoing administration of President Buhari is looking to turn that overdraft, essentially, which is worth about $50 billion in local naira currency, into long-term treasury bonds with maturities of several decades. There's a lot of argument within the Congress and in the courts whether that's actually legal or not. But more importantly, adding $50 billion on Nigeria's total debt pile will actually significantly increase the debt to GDP ratio. At the moment, everyone is expecting that Nigeria has a debt to GDP ratio of about 38%, maybe just below 40%. If we add that $50 billion overdraft account to it, we're well over 40 going into 2024. So For Nigeria, it's not really an issue about Eurobonds. To be honest, no one really has made any, triggered any alarm bells on these Eurobonds. It's about domestic debt. And with the record high interest rates, the cost of servicing this debt to the central bank by the federal government is unsustainable. And that is why they're trying to turn this into long-term, long maturity treasury bonds. In the end, someone will have to repay these, and still the burden of servicing these will remain high. And that, of course, is a burden that will be passed on by the outgoing administration to the incoming administration. So this is not yet a final solution to Nigeria's debt problem.
Okay, so we've talked about sort of the Eurobond situation, but that's not the only debts. You mentioned, of course, that was separate of the bilateral, the multilateral debts that's also being held, the private debt as well, which is another problem that African economies are facing now. But let's look at this. Part of Africa's sovereign debt conversation is also about who the players are and the bilateral and multilateral relationships that are parts and parcel of this situation. So one player that has had a lot of attention focused on it is China. A lot of fingers have been pointed toward China, that there have been accusations that the world's second largest economy has set a debt trap for African economies. So Dr. Besseling, let me ask you, does China really have this outsized role in Africa's debt conversation that we seem to hear that it has, particularly from the West, which is trying to encourage African countries away from China and Russia? Is this, this responsibility as big as it's made out to be?
You're absolutely right. There is a very popular, dare I say, narrative going around in Africa and globally about a debt trap, and particular a Chinese debt trap. I think let's look at the data for a moment. We have both already mentioned $700 billion in the cumulative debt accrued by African countries in the 20 years to the pandemic. Out of that $700 billion, just over $150 billion is accounts for Chinese loans, mostly owed to China Exim or China Development Bank or other Chinese state-owned or state-controlled entities, whether they be commercial or not. That does seem like a large amount, 150 out of 700 billion. But then if you actually dig down a little bit deeper, you'll see that about a third of that amount is actually owed by Angola only. Angola has borrowed about $42 billion worth of oil-backed loans from China over the past 20 years or so. In fact, the number may be significantly higher because we haven't actually uncovered everything yet. So Angola is very heavily exposed to China. Two other countries really are remarkable in terms of their exposure to Chinese lending. And the other one is Zambia. And there, of course, we already know about the undisclosed loans that Zambia has built up over the past few years in terms of infrastructure financing, some of which has been disbursed and some of which has not yet been fully disbursed. And the third country is the Republic of Congo. And the Republic of Congo, Congo-Brazzaville, actually tried to restructure some of its Chinese debt during the pandemic. It's not been very successful at doing so. But certainly, these three are by far the biggest borrowers from Chinese sources of credit relative to the size of their economy. Everyone else lags way behind all the other 51 other African countries. In terms of the size of their economy, they have much smaller Chinese exposure. Ethiopia, for example, about 12% of its economy is actually accounts for Chinese debt. Cameroon is about the same. We're talking about Ghana earlier. Just below 7% of its economy that's the proportion of Chinese debt. So we have here 54 African countries, out of which we can really pinpoint 3 that are almost undeniably in some sort of a debt spiral, whatever you may want to call it. And they will have big issues in terms of restructuring and continuing to service and restructuring these debts going forward, whether that's part of the common framework or not. But the other African countries, the other 51 African countries out there, are, as the data suggests, not at all exposed heavily to China. And they may not be stuck in this so-called debt trap after all. So I think we need to be really careful about where the data is pointing it and where the narrative tries to lead us to.
That's interesting. So very quickly, before I move to my next question, if Africa is not as exposed to Chinese debts as we've been led to believe, then who does Africa really owe money to?
So we've talked about China, we've talked about Eurobonds. And the other 2 or 3 big ones here are commercial debt, which is banks and export credit agencies and mutual funds. The other one is bilateral and concessional debt, which is owed due directly to other non-African governments and states, as well as the big Bretton Woods foundations like the IMF and the World Bank, or institutions like the African Development Bank. And the third really big one is domestic creditors. Local banks and insurance companies and mutual funds and investors that buy treasury bills and treasury bonds from African central banks. Usually, these are local banks and buying in local currency. So if you layer those together, Eurobonds are not the real problem here for most countries. And Chinese debt also is not the biggest chunk of debt. And certainly not bilateral and concessional debt, which if we're talking 15 years ago, it certainly was, but is no longer the case. It really, if you look at the data, on the external side, it is commercial debt. Owed to private creditors, whether they be banks or ECAs or institutional investors. They really own the biggest chunk of Africa's external debt. And then completely on the other side is the domestic debt. And that is very often forgotten in the African debt conversation, where we're always looking at external hard currency debt. But now with inflation so high and with interest rates so high, we're actually seeing the biggest problem in Africa in terms of servicing debt is on the domestic side, not on the external.
That's very interesting. All right, so there have been some attempts to right the situation, or at least put the debt conversation on the right path, especially for many African economies. We saw the G20 come up with a common framework for debt treatments after the COVID-19 pandemic, but we've seen only 4 countries sign up. None have been successful so far in any really restructuring movement from the framework. So what's the issue with the framework? Because it was touted sort of like this golden bullet in a way that was going to solve the issues, but it's barely solved anyone's issues. So what's the issue with the framework?
The common framework is essentially a joint initiative between the IMF, the World Bank, and the group of 20 wealthy nations, the G20. The idea behind it is to bring all the different creditors together, sit them around the table, and restructure the debt. The problem has been that certainly on the bilateral and concessional side, on the Paris Club side, there has been a lot of engagement. There has been very little engagement from China to actually commit to restructuring African debts, or in fact any emerging market debt. And there has been very little approach to the private sector. We talked earlier about the Eurobond holders, but also on the commercial side, banks and institutional investors who really hold the biggest chunk of external debt in Africa. And there's been very little approach made to these. So that is how the common framework, now 2.5 years into its lifetime, has not really seen any successful implementations. The IMF will say there was a successful implementation in Chad, but the World Bank actually denies that. And if we're looking at the moment, the way that the conversation is going in Zambia and in Ghana and even in Ethiopia, it looks like those are the other 3 common framework applicants still stuck in creditor committee negotiations. You will actually see that the way they are formulating the debt restructuring possibilities is very different to what the common framework applies. In fact, countries like Ghana are directly reaching out to China rather than going through the common framework. Countries like Zambia and Ghana are trying to make a deal with the IMF and some bilateral creditors rather than channeling everything through the common framework mechanism. So we've really got a common framework here which needed a revamp, which the April spring meetings by the IMF and World Bank was intended to do, but that simply hasn't happened. The momentum isn't there. And my feeling at the moment is that there will be a number of big debt restructuring deals in the coming weeks or months, particularly Ghana, potentially. And the IMF will call it a common framework success. But if you look at the data and the detail, in fact, it will be a bilateral deal rather than a common framework application. That's my thinking, that's my forecast on this in the next few weeks.
So, Dr. Bessing, before I let you go, a twofold question. You mentioned Angola before as being one of the countries even most exposed to Chinese debt, but Angola has also been held up, particularly in your report, as sort of a success story, the country that has walked itself out of a debt crisis. So what lessons are there in the Angolan situation that other African economies can pick up from? And then aside from that, your report also seems to be quite optimistic on what the debt landscape looks like for African economies in the coming year or two. Where does this optimism come from that Ghana, Kenya, Ethiopia, Nigeria will somehow find their way out of the situations that they are currently finding themselves?
Thank you for bringing that up. So my company, Pangea Risk, recently published a white paper, jointly published with our partners, Acre Impact Capital, which is freely available on our website if you would like to take a look. And here we look at the debt restructurings that have already happened on the African continent. The biggest one we've ever seen in Africa and the world, in fact, is in Angola, where $30 to $35 billion in Chinese debt was restructured at the beginning of the pandemic. Restructured in terms of pushing out the maturities and potentially slightly raising interest rates. That has given Angola the breathing space to recover its economy and to avoid these endless services of debt and endless payments on maturities. What Angola has also done on the other side is it has found a rapprochement with the IMF, where it signed on to a big funded program, where it implemented many of the IMF's austerity measures and restructuring of the economy reforms. Quite painful, particularly because it's happened during the pandemic. And it's also started a privatization agenda of state-owned assets. Privatizations, an IMF program, and a Chinese debt restructuring is what has made Angola one of the most counter-cyclical countries in the world during this current economic depression that we're seeing globally, where Angola's inflation has come down, Angola's monetary policy rates, interest rates have come down, and its economic growth has increased while its total debt burden has declined. That counter-cyclical success we have seen as a potential role model, as a paradigm, as a benchmark for other African countries to implement over the coming few years. But turning to your second question, we are quite optimistic at the moment that a number of African countries, which are in the spotlight by creditors, by the IMF and others, like Kenya and Ethiopia, or even those common framework applicants like Ghana and Zambia, will eventually find a deal if the politics of African debt restructuring will allow them to do so, particularly on the bilateral side, where countries like Kenya can make a deal with China on the big infrastructure loans, or where Ghana has already successfully restructured its local debt with local banks and pension funds. So there is a lot of scope here to make bilateral deals and to find a solution that is bespoke to each African country, rather than taking a multilateral approach and a one-size-fits-all approach that the common framework seems to seems to formulate. Other African countries are actually trying more bespoke solutions and trying to deal with their specific problems and more bespoke remedies to deal with their African, with their debt issues. That is what our white paper proposes. It's something which our company, Pangea Risk, analyzes and assesses for all African countries. And I think on that basis, there is actually, if we look past the narrative of the debt trap and we look past the warnings that we see about a number of African countries, the majority of Africa is actually looking quite optimistic going forward. And that will be crucial when we start to see new investors come along, with climate financing or impact financing deals on the table, and that want to engage with African countries. And once these debts are restructured, we may actually see some positive developments on that side.
All right, it's good to end a debt conversation, particularly concerning the African continent, on an optimistic note. Most of the time, it's a lot of doom and gloom, and as we said, warning bells. But to see some optimism in this is very, very good. So, Dr. Besseling, we will definitely be in touch. The conversation will continue as long as the restructuring is happening. The bilateral and multilateral conversations and relationships have to go on. And so we look forward to having you again on Business Edge. Thank you so much for joining me.
Thank you for inviting us. All the best.
All right. And of course, the economics of African debt restructuring also has politics. And that's actually the title of the report from Banjia at Risk, which is The Politics of African Debt Restructuring. And it's a really fascinating report that breaks down the country by country specifics and how nuanced and complex the African debt conversation actually is. And definitely it's one we'll continue to follow up. You're watching Business Edge. We're getting straight into international business headlines. And after that, taxes. Nigerians, be ready. We have the conversation coming up.